One of the interesting things that I learned about property investing when I was living in the West was that a lot of investors will often go into their own domestic market. They often invest even in their own local city exclusively. And they go in with the premise that even though the fundamentals of this property aren't that good, even if the neighborhood is newer, even if the yield is very low or even negative, the idea is that real estate values will always go up, that the market will wash away a multitude of sins. Now, we've seen in the last decade or so how that's simply not true. Real estate markets don't always go up. But in this video, I'm going to make the case for why much of what you know about investing in the West is absolutely wrong. Hey guys, I'm Andrew Henderson, and if you want to learn more about Nomad Capitalist, what it is that we do, how we help people, you can learn more at nomadcapitalist.com. Now, let's talk about real estate. I've mentioned before how I lived through the Great Recession and the Great Real Estate Crash in the United States. Particularly, I was in Arizona at the time, had a lot of business interests in California, and had some business interests in Las Vegas, kind of like the triangle of doom in markets where you had seen big run-ups. My family and I had been vacationing in Arizona for a long time when I was a child, and so I'd kind of seen, the markets steadily go up. What was interesting is it all came crashing down. You saw properties in Las Vegas that I think were marked down by more than half. People were getting tremendous deals, and now you've seen the market go back, and it has overheated tremendously. And so this, I think, has led a lot of people, particularly in that part of the United States, but really in the United States in general, and I think some other Western countries. I know people in Australia I talk to often feel the same way, where there's this idea that real estate will always go up. Now, does real estate generally go up in the long term? Yes, but what I'm talking about is more of the mindset of the short-term investor who's looking at short-term metrics. And by that measurement, real estate does not always go up. Now let's talk about a couple of things that I think should be changed. And so what I've seen is people are investing as if they're guaranteed a return. One of the things that I saw 10 or 12 years ago that I'm now starting to hear about a little bit again is people who are actually buying properties that are putting them, as leveraged as they possibly can, high loan-to-value rates, putting down very little cash in order to beef up their cash-on-cash returns. But they actually don't have any cash-on-cash returns. They're losing money every month. Have you seen this? People who lose money every month, or they make such a small amount of money that after taxes, after the occasional roof leak, after accounting for their time, even at a McDonald's wage, they're actually losing money, right? So, if you could be sitting around doing something else and making money with that time, then that also is a cost of ownership if you're managing your own properties or thinking about your own properties. Okay, so you've got a lot of people in Western markets, particularly in the hot markets where people are pouring money in, the Vancouvers, San Francisco, Los Angeles, Sydney, and others, where people are willing to accept such tiny yields that they're basically losing money net. But they say, oh, I'll make it up when I sell. Now, to me, this kind of attitude, you see, it's often indicative. Whenever I hear that, I often see people who don't understand the core principle of real estate, which is you have to make money on the buy. Okay, you can't overpay for the property. In fact, I think I've never purchased a property. I take that back. I did it once in Georgia. But other than that, I've never bought a property from a developer. And this was a very small developer. It was basically a very small building. So it's kind of a different story. But I would never buy a property from like a big development. So if I'm buying a house in Australia, the US, or whatever, I'm not going to go and buy a brand new build from a guy who's selling those properties. You can rarely negotiate. The prices are often higher. You're often paying for certain amenities that are being sold to an end user, right? I mean, how many times have you seen this if you've looked at overseas properties? All of our toilets are from Italy. Who cares if the toilets are from Italy, okay? Am I getting a good deal on the property or not? Don't get sucked into these deals. You have to make money when you buy. And so if you're not making money on the buy, then you're going to have a very hard time making money later. So let's just recap the scenario. Overpaying for property. By the way, I see people all the time. They come to places where I'm saying, hey, let me show you around some properties. Okay, Andrew, that's nice. Let me go over here. And so often I'll see people who say, I'm a disciplined financial investor. I'm here to get the highest yield possible. I'm going to pay the lowest price possible. Oh, look at this shiny new object they just built. The developer told me it's a really great deal. No, you want to buy smart. And when you buy smart, then you get in the mindset of, well, hold on a second. Am I making money every month? Am I making money every year? Now, I own properties that I do not rent. They're for my personal use. My friends are in town. I have a team member, someone who works for me is in town. They stay there. And I get a certain yield because I get I don't have to stay in a hotel when I go to that city. I get a productivity yield. I feel nice being in my own surroundings when I'm there. Again, I can have friends or family members or people who work for me stay there rather than paying for their hotel. But that's not really a yield, right? So you can do that. I don't consider those properties investments. If I make money in the long run, which I imagine I will, okay, fine. But really, it's a place to park cash. It's a place for my personal use. That's a certain portion of my portfolio. But if we're talking about a pure play investment, okay, the numbers have to be there. And so rather than losing money every month, effectively, to hopefully make money later when the property market goes up, in a market where we know there's volatility, my suggestion is simply this. Find markets that are less correlated to that volatility. The more emerging and the more frontier a market is, generally the less correlated those markets are. Take a look at Cambodia, for example. I've talked about Cambodia for years because it's been one of the solid performers. It's so hard to find a country that ticks as many boxes as it does. And so, you look at Cambodia. Since the mid-90s, they have not had a recession or a decline in property prices. You had the Asian financial crisis. You had Y2K. You had the global recession of 08, 09. Just kept going up to the point where now I think if you want to get into that market, you better hurry because it's beginning to get a little bit pricey in some areas. And so number one, I like a market like that. A lot of the markets we talk about, Georgia, Colombia, et cetera, I like it because there's less room to decline. I mean, property theoretically has some kind of fundamental value. Even you go to Venezuela or Iran, I mean, people are holding on to core properties because even though the economy is in a tailspin and the currency is going crazy, there is a fundamental value to those properties. Let's take Cairo, for example. I'm looking at properties in Cairo, $600 a meter, $700 a meter in very central locations. How much lower is that going to go? Is that going to drop by half? I guess anything's possible. I'm putting my money on, a suburb of Phoenix, Arizona, Queen Creek, Arizona. That's a lot more likely to go down in value in half than something that's in, the embassy district of a city with 20 million people. And so what I think is people unfairly apportion risk to emerging economies or to frontier economies. I look at it the other way, okay? Because again, let's go back to the story of the folks who, are buying these properties and they're losing money on them. I lived in Arizona. I saw California. I saw Nevada. And again, I think it's the same in parts of Australia and other parts of markets that have gone up. And there's this kind of property, boom going on. Where do you buy? Are you buying in the best location in Phoenix? Are you buying in Beverly Hills? Are you buying in downtown Los Angeles, which is obviously 15 years ago? You wouldn't buy in downtown Los Angeles, but now you would. Are you buying there? No. I need people who are buying in Victorville, California. Look it up on Google Maps if you don't know where it is. Look at Victorville, California, and tell me if you think that's a good place to buy. But they were building houses like crazy, and people were buying them, and people were moving up there. They were holding them as investments. I had a guy when I was 22 years old, and I spent 7 months living in California. I lived in Rancho Cucamonga, California, because I was doing a consulting job, my first ever big job with a place in San Bernardino, which you wouldn't want to live in. And so I wanted to live as close as possible to Los Angeles without having to spend an hour in the car each way. And so I lived in Rancho Cucamonga. This guy had a decent job, but I don't know, maybe made $100,000. He owned $1 million house, and he owned 4 condos in this kind of townhouse community that I was renting in. Had over 2.7, I don't know, almost $3 million in debt, if I recall. Put almost no money down and was losing money every month. Didn't work out. When I left, it was actually a good wake-up call because I didn't really want to live there anyway. It was good to get out of California. but I had to leave because I started getting foreclosure notices. Okay, why would you want to invest in a market where those are your investors? Okay, you go to the markets that we talk about, people are putting cash, sometimes physical cash, on the barrelhead to buy central stuff in central locations. And so if you do that, if you follow that principle, if you look at emerging markets and frontier markets where they have decent governance, where lower taxes, ease of foreign ownership, you can buy in good locations. I've talked about tier A locations, and you can afford that. You go to a Bogota, I'm buying tier A locations for $1,500 or less a meter. Okay, so what is 100 in the U.S.? It's $140 a foot. Where are you buying for $140 a foot? That's brick construction in the middle of a city that's the 4th largest city in the Americas. You're not. So I see a lot less room for those prices to go down. Now, some of these countries have currencies that are kind of weird, but even then, I mean, prices still they do keep pace with the currency. You're going to have less potential for decline. You're going to be able to buy better properties that have a greater fundamental, core value, better fundamentals. And you're a lot more likely to collect cash along the way, because why? Not everyone can get into the property market. Not everyone can go and take out 5 loans with their $100,000 income, take out $3 million almost in property loans. They have to put cash. There's much more discipline there. When you're putting cash, you have to be disciplined. And so the market is not populated by a bunch of investors who are just borrowing the whole thing and then allowing it to crash down. And so for me, that's the case for the emerging markets. We've talked about Georgia. We've started talking about Armenia. We've talked about Colombia. We've talked about Cambodia and others. We're going to be talking about a lot of the markets that we've been researching and that we really like fundamentally at Nomad Capitalist Live this year, our live conference. And so you definitely might want to check that out. But this to me is the case for emerging and frontier markets. It's a totally different set of circumstances than you're going to find in the United States. And there are some things where, again, you're not going to get 96% financing, but I think you're going to have a much better experience. And so if you're building wealth in the long run, to me, these markets make a lot more sense. How can Nomad Capitalist help you? 4 ways. Number 1, subscribe to our channel and click the notification bell to make sure you get our new video every day. Number 2, get a copy of Nomad Capitalist, the book. You'll learn a lot of my personal experiences over a dozen years of studying this stuff, as well as exactly some of the strategies that you can use to build your Nomad Capitalist plan. Number 3, if you're not sure where to start, but you want to come and learn from my team and I, you want to come and mingle with like-minded people, learn more about our live conference, Nomad Capitalist Live. It's coming up soon. And number 4, if you want some help right now because you've got a burning issue, you need something solved, you want to lower your taxes, get a second passport, or build the Nomad Capitalist lifestyle of your dreams, go to nomadcapitalist.com and click on Become a Client.